Hey everybody, good morning. Welcome. It is Pete. Today is Monday, June 8th, 2020. Happy anniversary to my brother and my sister-in-law. 29 years this year. That's a long time. Seems like last week's message resonated. We had quite a few people sign up for the boot camp this weekend, and really the message was the market's been going straight up. There's really no other way to put it, whether it went sideways or whatnot. There hasn't really been a change of trend at all to the downside. As a matter of fact, we had very, very few stocks even come up in the bearish scanners for the last month and a half or so. So I think the message of why haven't you been making more money? And if you didn't have an answer to that, that meant that there's a gap between what you know and what's available. And a lot of people stepped up and invested in themselves this weekend, and I applaud you because the cost of the investment of the 30-day boot camp is less than what most people risk on one trade. So, one trade versus a lifetime of that skill to make as much money as possible. To me, it's kind of a no-brainer. So I applaud everybody who got started this weekend. However, if you did not get started this weekend, today's episode of Stocks for Breakfast is going to discuss some simple processes so that you can take advantage of what's available, but just as important, and the part that I think that is holding a lot of people back right now, which is, but what if the market turns around? What if I'm the last person to buy when it eventually does start to see some profit taking and selling? It could be this week. We have the Fed this week. I know we had those amazing jobs numbers last week that catapulted the market higher, and we just kept traveling in a bullish manner all day on Friday. We'll see, but again, that's the point. And I want to get across here. We're not guessing it might happen this week. Great, profitable traders, and that could be you. I'm not talking about somebody mysterious. I'm talking about you. It could be you looking at charts and saying, I completely understand what I'm looking at. And maybe you do it the way I do it, which is where I'm looking for order flow, putting the argument together, building an argument for a great idea. Or it could be a strategy that you use. It could be a strategy that you learn from somebody else. It doesn't matter. But the number one thing is you need to have a structure in place that says right now buyers or sellers are in charge. That's the key. And is it obvious? And how do I know when it's changing? That's the big thing. There seems to be a lot of people, at least based on the emails and the comments that I got, left a lot of money on the table. And again, a lot of money is relative to everybody. Left money on the table for fear of the market turning around. Now, is it eventually going to turn around? Yeah, I mean, it depends on where you read and what what website or channel or news source you listen to and how great or versus what's coming, doom and gloom. And by the way, that could be a huge part of why, if you feel you left money on the table, that could be why. Stop listening to the news. I get people, it's definitely interesting to read, but don't let it influence what you're doing as far as from a money-making perspective, which really highlights the fact that you need to be the asset. You need to be the person making decisions. You need to be the person that looks at a chart and says, I understand what I'm looking at. I truly believe I have a grasp on this stock and on the market, or a bunch of stocks, whatever it happens to be, and say, I'm going to make my own decisions. I don't care what Jim Cramer said. I don't care what Market Watch said. I don't care what all these other sites say. I'm going to make my own decisions. That's a big part of why people left money on the table, because they're reading about the pending turnaround. And is it coming? Of course it's coming. Absolutely it's coming. If anybody doesn't want to admit that the market was saved by the Fed and the stimulus package, they have no idea what they're talking about. Of course it was. Speak to all the businesses around you and ask yourself how many of those businesses are still open. We actually just had one here, a large restaurant, easily fits 300 people, one of the most popular places down here where I live in South Florida, just announced yesterday they're closing. 300 people capacity. Think about that. So what's going on under the hood? But that should not stop us from still buying until we see a change. It is what it is until it's not. That's really what it comes down to. So we're gonna actually take a look. But the first thing I want to get across, we're going to look at a $300 stock and we're going to look at a $30 stock just to drive the point home, because not everybody can trade a $300 stock. We're talking about stocks for breakfast. We're talking about Stock Trading Pro. So we're not going to talk about, yeah, you can definitely trade those same stocks with options, but I want to give you a feel for looking at the charts. But here's the single biggest thing that I want to get across. Chart reading is simply looking for patterns. Okay, tape reading is putting the pieces together that builds an argument for your A+ trade. It doesn't matter if you use moving averages, trend lines, individual candlesticks, none of that matters. What matters is you actually have something that definitely says this is bullish or this is bearish, and then only then do you look for ideas in that direction. Now, here's the big key. Here's what to write down, especially if you're a little overwhelmed by all the by all the possible things that you could be looking at. Higher time frames matter. Oh, wow, I sound like a political statement here, but that's not what I meant. Higher time frames dominate. In other words, you might be looking at a daily chart for a swing trade, but the weekly chart and the monthly chart and the quarterly chart are the ones you should be looking at first before you put on and fine tune your entry in the direction of that swing trade. If you're a day trader and you're looking at a 5-minute chart or a 15-minute chart, you should always be looking at the daily, weekly, and monthly charts. You want to be putting those pieces together because the higher time frames are where the bigger money commitments happened, and then you hop on board in the direction of those higher time frame commitments on the lower time frames. And then ironically, you actually go from the higher time frames for the idea, the lower time frames to fine tune your entries, but then you go back to the higher time frame, usually one time frame above your entry price, to manage how long you hold that trade. So in other words, if you're on a 5-minute chart, you go to a 15-minute chart. If you're on a daily chart, you go back to a weekly chart, depending on how long you'd like to hold that position. Because, and again, I'm sure you've experienced this, every single wiggle and jiggle, I keep saying wiggle and jiggle, I've been using that for years, on your entry time frame seems to have so much power over the way you're looking at the stock. It can sometimes shake you out of a really good position, and then you send me an email or you leave a comment, say, oh, I had it on everything, it was perfect, but one candle got me out of the trade. That's where going back to the higher time frames can really help on that, because the higher time frames tend to be a lot more obvious. They're a little bit more smoothed out, and less one candle down that might take you out, or one candle up that might take you out of the position. So this is what I want you to write down. This is a very big thing. If you're overwhelmed, if you're not sure what to look at, always start out with the higher time frames to say, is it obvious? Is it obvious buyers or sellers are in charge? If the answer comes back yes, then you drop down to a lower time frame. So in other words, from a monthly to a weekly to a daily, or a weekly to a daily to an hourly, whatever time frame that you're comfortable with your risk, because you're going to most likely be entering with stop losses on that lower time frame. Then you only trade in that direction until you see a reason not to. Now, a lot of people coming back and saying, but what about when the market went sideways for that better part of 3 weeks, right? But that didn't mean it turned around. That was a potential change of trend. We were very careful to say that was a PCOT, potential change of trend, which means that the upside potential is lower until you clear those levels where it stopped, or you would potentially look at a reversal if you broke to the downside, and a lot of stocks did not. Matter of fact, the market just went sideways and then took off again. So we're going to take a look at 2 different stocks. We're going to go from higher time frame to lower time frame, and then you can start to do the same thing in whatever stocks you happen to be trading on a regular basis. So we're going to start out with Lulu here. Let me get that off the screen. So obviously here in Lulu, we're going to go out to the monthly charts, and this is a little bit more for a swing trader. And I know what's ironic is it's so easy to look at after the fact. We want to help you be able to identify all this stuff prior to getting into the trade. So you can see here clearly whether you're using, I'm actually going to pull up the most common moving average, the 20-period moving average, where since September of, well, let's say, what month is this? This is December of 2017. You can clearly see that even the shortest time frame, which a lot of people use this as their momentum time frame, the monthly chart of Lulu has basically been bullish for this entire time, save for a couple of months, right? Then you go out to the weekly chart and you try and look at the same exact thing. So you have the longer time frame being bullish. You drop down now to the weekly time frame, so you're kind of narrowing it down to make sure the current price action is in sync with your longer term picture. Then you would drop down. So in other words, we're building an argument. The monthly is bullish. The weekly is bullish. Again, during this is actually kind of interesting. This spot right here, and then what happens here. So during this period here, November, December of 2018, which I believe was when the Fed announced they were not going to cut rates. I think the entire market came down in that moment. This is an area where you're not in sync. So multiple time frame analysis is not in sync. So you would do nothing here because there's a conflict. But then here in January, everything for pretty much the entire 2019 and into prior to the pandemic in February 2020 was bullish. So what does that mean? So that means then you go down to your daily charts, and now you look. I'm going to zoom it out here. Let's actually just start with 2020 because it's easier. So now in 2020, you're looking for it to be bullish. Actually, no, I have to go back here because the pandemic kind of skews it. So in the windows of opportunity here where the price action is above the 20 period moving average, that's when the 20 on the daily is in sync with the weekly, which is in sync with the monthly. So again, the higher time frames dominate. You're looking for the biggest picture where buyers or sellers are doing something obvious. Then you drop down to the next time frame, which in my case here is the monthly, and then the weekly to see, okay, are they on the same page? That's what I want to know, is all of that buying pressure doing the same thing. And then we kind of drop down to the lower time frames to say, okay, now we're going to start to fine tune our entries. So we can get all the way over here to the point of where we're looking at after the pandemic. In this area over here in April, Lulu has been above the 20 period moving average for the entire time. So this is where a lot of people are getting angry where, okay, I get it. No, who wanted to buy the bottom? It was a very risky situation because the news was very negative. You had no idea where the bottom was. But if you read the tape, if you put some of these pieces together, and again, I'm oversimplifying a lot of what we're looking at right now because then you still have to learn how to make money. Setting up ideas and making money is a big difference, right? That's that difference between being angry and being profitable, right? Or disappointed, I should say. But the point is, once you start to learn how to put these pieces together and then you learn how to actually make money on these trades, you start to look at this kind of price action and you say, my gosh, it was so obvious. I wish I had this structure prior to this happening. So we're going to take a look at another stock that we've been really calling out for quite a bit. We're going to take a look at Penn over the monthly charts, and we'll go back to these same time frames. And what's interesting here is you can see that for quite a bit of time, even though it was an $8 stock or less than 10, it was still slowly grinding higher. But then here in this area, March of 2017, we basically had an entire bullish run for an entire year. Then you drop down to lower time frames. And you can see here, 2017, 2018, pretty much bullish the entire time. So the point that I want to get across here is that once you have a structure for understanding how to read the tape, which again, higher time frames dominate, whether it's the monthly, the weekly, the daily, the hourly, or if you're day trading, then you start to go down to the daily, the hourly, the 15 and the 5-minute chart. Those lower time frames that you spend all day staring at become nothing more than your entry time frame, where instead of being, oh my gosh, it's going up, oh my gosh, it's going down, you're not doing that anymore. Even on the daily charts, you start to look at those higher time frames for longer term swing trades. You start to say now the daily chart, the fluctuations every day, which in Dow theory is called the daily fluctuations versus the intermediate term trend versus the higher time frame. Those fluctuations don't matter anymore. They're nothing more than where you're fine tuning your entries in the direction of those higher time frames. So I got a lot of feedback this weekend about people being angry they didn't make more. And if that was you, number one, I highly encourage you take a look at what's involved in the boot camp and also see some of the success stories that we have. If not, use this basic knowledge to at least set some of your trades up, but why not accelerate it and get in there and join the community? You get my exact trades, exactly when I'm looking at them, and you get some really good feedback from everybody else in the community too. That's a big deal too. Everybody in the group is really helpful, which I appreciate a lot, because it makes people want to come out of their shell and ask questions, which really is what accelerates your personal growth, right? So anyway, that structure, it's called multiple time frame analysis, higher time frames for the idea, lower time frames to fine tune the entries, and then you go back to the higher time frames to manage those winning trades, and you stay with them until you see a reason not to. So that's today's episode of Stocks for Breakfast. If you have any comments or feedback, or especially some questions about what we just talked about, absolutely drop a comment below. And if you find these videos helpful, definitely subscribe. That would mean the world to me. Have a great day, everybody.